He's not teaching Latin American studies.
Can't wait.
He's focusing like so. My dad's
Okay, hello everyone. Our last class. We should have a few minutes at the end if we want to cover some stuff again. I'll take from the top and we'll go from there if you want to vote. And we'll finish up a little bit first on chapter 11. Okay, so operating issues for S corporations. Okay, so ordinary income and loss allocations must be made and based on the number of outstanding shares. Remember, there's only a one class of stock arrangement in S corporations. So we don't have special allocations that we have in the partnership world. So much more regimented, but we have to take the results of the S corporation and send them out to the owners, just like we do in a partnership, but it's much simpler than we do in a partnership because we don't have, anything that's within the partnership agreement that might specially allocate certain types of income or certain geographical income to different partners in different manners. The S corporation is more straightforward based on ownership percentages. Okay. However, the S corporation must supply information to each of its owners detailing the amount and character of items and income flowing through the S corporation so that the owners can report the income or loss on their separate tax returns irrespective of cash distribution. Right? So that flow-through mechanism is very akin to partnerships. Everything has to go be reported out. This is done via Form 1120S and Schedule K1 of that. So Form 1120 is the classical corporate tax return filing, the -S, obviously S corporation. Looks very similar to the front part of it. It's got income, expenses, down to taxable income. And when you get towards the later pages, you'll start seeing where this distributive share type analysis, which is not existent in the 1120, right? Because the corporation doesn't have any of that, it doesn't report anything to its shareholders. Why? Separate taxpayer, right? So S corporation has this Schedule K1, which is also the schedule that's the same name as the schedule in partnerships. The K1 is the communication between the flow-through entity and the owner who is going to report that flow-through activity. An S corporation determines each shareholder's share of ordinary business income or loss and its separately stated items. Remember we talked about separately stated items in partnerships. Why do we have to do that? Because those items might be treated differently at the shareholder level depending on the shareholder's profile, right? Just like a partnership. Partnership has separately stated items because we don't know. I don't know if you're entitled to preferential treatment on capital gains or not. I don't know if you're entitled to preferential treatment on ordinary dividends or not. So that has to be separately stated so that you can make that assessment at the individual and owner level as to what those results are. So it's the separate tax profiles that cause that spiking out of the separately stated items. Okay. Last few examples. 1111 is Iowa.
Thank you so much.
Well, to the afterward, say corporation, so no cost goes to the shareholder. Allocation is 2025, together between corporation, income goes to ownership. Shareholder owns one side. He had $259,000 of net income.
So let me pause you there. If someone tries to get tricky and ask you what's the separately stated items and the shares of ordinary income or loss, and somebody tells you it's a C corporation, it's a zero, right? There's no reporting up. that's indicative that we don't have any separate, or we don't have any special allocations or anything like that. It's just the 240, we have 1/3 owners, so each gets a 1/3 of the 240,000, so each gets 80,000. Right? If there's a partnership, likely that would be chopped up differently based on special allocation. So those are also shared 1/3, 1/3, 1/3, again, because I can only have one class of stock for a S corporation, but they're separately stated, meaning I have to highlight them, I have to spike them out, so they're not buried within the overall income and loss, so that the S corporation shareholder can then assess, well, is the interest income or dividend income have a different tax effect to me based on my tax profile. That's the reason I separately state that, not because I'm treating them any different, because I get a 1/3, 1/3, 1/3 of all items. Okay. The last item, just real quick, down at the bottom is informational items. You see section 199A, that's QBI, you think way back to individuals in the fall. Qualified business income, that's flow-through income from a trade or business that meets certain requirements. I don't know as a shareholder, does my S corporation qualify to generate QBI or not? That's important to me because if it does, I want to take a 20% deduction for my QBI. So again, that has to be separately spiked out, and it's an informational item. That would happen in a partnership setting as well. I think the author should put that as an example in partnership materials as well. But that separately stating that or spiking it out so that you can see that allows the shareholder then to decide what that means to them. Okay. Okay, let's shift to tax basis. So our initial tax basis, S corporation shareholders determine their tax basis in their S corporation stock to determine any gain or loss they would recognize upon distribution or sale, and the deductibility of losses. That's the same rule as partnerships, right? So it's distributions. You're going to see here we maintain our outside basis in S corporations, similar to the way we do for a partnership with some subtle differences, but it's going to drive distributions and the taxability of distributions or not, okay, whether they're taxable or not to the recipient. And so I need to know what that outside basis is. If I sell the S corporation stock, I obviously got to know what the basis is, like I sell any asset. And then the deductibility of losses. Just like in a partnership, I can only deduct the losses to the extent of my outside basis. Can't go negative in my outside basis. The same thing happens in an S corporation. And why do I have similarities with the partnership? It's a flow-through. Well, flow-through. There's corporate-like aspects of S corporations as well. So, if the stock was received, so we're talking about our initial stock basis. If it was received in exchange for the contribution of property and the requirements of 351 are met, the shareholder takes a substituted basis in its S corporation stock. Right? I substitute the basis of the property I contributed, becomes my basis in the stock that I received, and the S corporation. And in the S corporation stock, equal to its tax basis of property contributed, less any liability associated with the contributed property that's assumed by the corporation, which is the same result in the C corporation setting. I contribute property. If the corporation takes on my liability as part of that, then that reduces my outside basis. The shareholder's tax basis is increased by any gain it recognizes, if any boot is involved, and is decreased by the fair market value of property received other than stock. Those are the same rules I put in the bubble here as the C corporation rule. So you can kind of see why the S corporation is a hybrid. It's kind of got features of both. It just depends on where you are in the particular rules as to what you're doing. But the formation requirements and the implications to the shareholder and the corporation are the same. C corporation, S corporation, and whether it has boot involved or not. If instead the shareholder purchased the S corporation stock initial tax basis is the purchase price. Right? That's the same if you buy C corporation stock or you buy a partnership interest. Basis starts off with what you pay any other asset. Okay. Let's do number 12 is capital.
At the beginning of 2024, the Corp is $30,000 of cash and then fair market value of $30,000 and an adjusted basis of $125,000. So this is covered by a $47 loan to the Corp. Their interest is $125,000 What tax basis do you call for that impact on the future of the 2024? So the Corp is
They just need to change. So this would have been the same whether it was a C corporation or S corporation. Exact same result for both all. Okay. So while C corp, so now we're going to talk about the annual basis adjustments. So now we're going to drift away from the C corporation world. So while C corporation will govern the initial S corporation stock basis, subsequent adjustments to tax basis more closely resemble those applicable to partnerships, right? I don't do anything with my basis in a C corporation. It doesn't matter if the corporation makes money, loses money, distributes to me or not. My basis doesn't change, but for if they make a distribution in excess of E&P, then I might reduce, right, my second tranche of the distribution using my basis. But for most intents and purposes, my basis in my C corporation stock is static. Doesn't change, right? Whereas once I determine my initial basis in the S corporation, now I'm going to start moving and letting you my basis in my partnership interest. So, like partnerships and S corporations, tax basis is dynamic and must be adjusted annually to ensure that taxable income, gains, and deductible expenses and losses are not double counted by shareholders either when they sell their stock or when they receive distributions. So, as income flows up to me, positive, I increase my basis. So that's because I want when cash comes out, I reduce the basis back down. So it's kind of like a measuring stick. It goes up when I make money, it goes down when the money comes to me. And what that also protects me is if I sell the stock before the second transaction happens when it's distributed to me. I already picked up the income, right? If I haven't gotten a distribution from the S corporation yet, I need to raise my basis in the S corporation stock because the value of the stock goes up dollar for whatever's left in the S corporation. And I don't want to tax that gain a second time. So I have to lift both sides of the gain calculation, realized and adjusted basis at the same. That prevents me from being taxed twice. Okay. And tax exempt income and non-deductible expenses are not ultimately taxed or deductible. That's the more esoteric view of this, but I also need to increase and decrease basis on those two fronts to make sure that I don't take something that was tax exempt at the S corporation level and make it taxable at the shareholder level. I put in comments on the slide so you can see those just to make sure you understand what those are. But the tax exempt and non-deductible expenses are also there to protect and preserve not double taxation, but to make sure something stays non-taxable or stays non-deductible. Okay, so S corporation shareholders make the following annual adjustments. This is very similar to the red and green font of the partnership slide we did several weeks ago. I increase it for contributions. Right, if I put more property in there, I have to get through 351. Right, this is my control group test. Those three requirements. So I may have trouble doing a subsequent contribution if I don't have a control group in place. But I get increased basis either for my substituted basis or maybe it's taxable and then fair. And I increase it for my share of ordinary business income and separately stated items that we just went through in that example. and for my share of tax exempt income. Okay? The reason for the tax exempt income increases my basis is because, again, the value of the S corporation went up by the receipt of the tax exempt income because, say it's municipal bond interest. I collected interest, say I collected $100 of tax exempt municipal bond interest. The value of the stock went up by $100. If it's not distributed to me, if I sell it before it's distributed to me, I gotta raise my basis or the gain becomes taxable. So I've taken what was otherwise non-taxable and made it taxable, so I have a larger gain because my amount realized went up dollar for dollar by the receipt of the tax exempt income. If I don't raise my basis, then I've shifted what was non-taxable and made it taxable. I decrease it for distributions. As I, just like in partnerships, as distributions come out of the S corporation, I lower my tax basis. And I decrease it for my share of ordinary business loss and separately stated expense items. So I have to lower that because I'm deducting those losses on my shareholder level tax return. And then I decrease it for my share of non-deductible expenses. That's the flip side of what we just talked about on the tax exempt side. In order to maintain that non-deductibility, I have to lower my tax basis so that I don't get an inadvertent benefit of a higher basis in S corporation. Importantly, S corporations are not allowed to increase their tax basis for any entity level debt, unlike in partnerships. So if you go back to this slide in the partnership section, we had a line in there for increases and decreases for your share of partnership liabilities. You don't have that for S corporations. Okay? I think the reason you don't have that is because it is a corporation, right, legally. We always start as a corporation, we elect to be an S corporation. So there is no, you're never liable for the corporation level liability, right, because you got a limited liability of the corporation. One of the key features of non-tax feature corporation. So you ignore changes either borrowings or repayments of debt at the S corporation level. That did not affect the shareholders level. Adjustments cannot reduce tax basis below zero, the same rule as for partnerships. So that will be key when you try to deduct losses or you have distributions. Those things, if those amounts are more than your outside tax basis in the S corporation, then that apply that in 1113 for loading perspective.
Given the shareholders' 2024 basis in the CCS stock, in example 1112, what basis does each have at the end of 2025 after taking into account the information in Exhibit 11? Answer is full 198,000, Sarah 243,000, and Ken 288,000. Note that the shareholders do not include any portion of CCS debt in the stock basis.
So we started with that initial basis from the prior example. Sarah and Chance contributed cash, so they just got 120. And then Nicole contributed non-cash and had a liability assumption. We went through that calculation. She got 115. But then you see each one of these that's built on one of those other examples that we started with. I got results for the current year divided in thirds, right? So I got 1/3 of ordinary income, 1/3 of interest, 1/3 of dividend. Again, it's dynamic, so those all go up because I'm currently taxed on those. I get basis in my S corporation for that. And I don't do anything with the liabilities if there were any at the S corporation level. Okay.
What if, suppose that in addition to the amounts in Exhibit 11.2, CCS also recognizes 1,200 of tax-exempt interest income in 2025. Nicole's share of the separately stated item is $400. Taking this allocation into account, what is Nicole's stock basis at the end of 2025? It is $198,400. Tax-exempt income allocated to Nicole as a separately stated item increases her tax basis to ensure she is never taxed on her share of the tax.
So that's what I was trying to explain earlier. If that 400 means the value of her 1/3 ownership of the S corporation went up by 400, right? If we were to sell it before her 400 was distributed to her, we don't want to tax her on an additional 400 of value because it's tax exempt. So to do that, we have to lift the basis by the same 400 so the gain is unaffected. Okay, that's the reason why tax exempt income. I think it's easy to think about why taxable income gives you a boost in your basis in the stock, but why is tax exempt income as well? It's the only mechanism to keep removing tax on that. Same thing on the distribution side. If we didn't increase our outside basis by 400, then the distributions of the 400 would automatically start arbitrarily reducing her basis too low, which would again cause additional exposure to that tax exempt income to become taxable. Okay, let's talk about operating distributions and distributions of cash. We'll talk about non-cash in a moment. So the rules for determining shareholder level consequences for operating distributions depend on the history of the S corporation. Whether at the time of the distribution, it has accumulated earnings and profits derived in a prior year when it was a C corporation. So remember, an S corporation can have a life as a prior C corporation. So we can make an S election midstream. You started as a C corporation, you had a number of years as a C corporation, then you became an S corporation. The complexity when you do it midstream is, do I have earnings and profits at the corporate level, which I paid tax as a C corporation because it's a separate taxpayer, but they haven't yet been distributed, right? You distribute earnings and profits, that's a dividend to the shareholder. So now that I'm an S corporation post-election, how do I deal with that prior attribute that was at the corporation but has not yet been distributed? Things get complicated because now I can make distributions of S corporation profits. There's no tax, adjustment to outside basis. But when do I make a distribution of those pre-S election C corporation profits? That can be complicated. So we're not going to go into that level of detail. So for an S corporation with no C corporation accumulated E&P, so that could either be because you made an S election, data formation, maybe affected data formation, or you just paid out all of your earnings before you made the S election, so you didn't have that attribute at the moment you made the S election. The tax rules for operating distributions are very similar to those applicable to partnerships. So they're non-taxable to the S corporation shareholder to the extent of their tax basis in the stock. After increasing their tax basis for income allocations for the year of the distribution, with distributions in excess of that tax basis resulting in the recognition of capital gain by the shareholder. It's the same rule we talked about in partnerships. So long as I got outside basis, I can take cash out up to the extent of that outside basis. I go $1 in excess of that, $1 capital gain starts. Why? Because I'm getting cash, and I can't cash, and the presumption here is that it's US dollars. As a US taxpayer, I cannot have gain or loss in US dollars. There's nothing in a distribution of cash scenario for me to reduce the basis and to reserve non-recognition. I have to recognize the same thing we talked about a couple of times ago on partnerships. Okay. Megan? Sorry, can't read my own writing.
Suppose CCS has been an S corporation since its inception. On June 1st, 2025, CCS distributed $30,000 to Nicole. Her basis in the CCS stock on January 1st, 2025 was $20,000. For 2025, Nicole was allocated $15,000 of ordinary income and no separately stated items. What are the amount and character of income Nicole recognizes on the distribution, and what is her basis in CCS stock after the distribution? Nicole has $0 of income from the distribution and a $5,000 basis in stock after the distribution. $35,000 minus the $30,000. Her stock basis for determining the taxability of the distribution is $35,000, or the beginning basis of $20,000 plus the $15,000 income allocation for the year, which is taxable to
Yeah, so
What,
the only trick there is, right, I increase for my current year results. I first get the boost of the flow through of income, that's gonna boost my outside basis, which gives me more room to take the distribution of cash out before it reaches zero.
Assume the same facts, except that CCS distributed $40,000 to Nicole rather than $30,000. In this case, Nicole has a $5,000 long-term capital gain. She has held her CCS stock for more than a year and no more basis in her stock. The distribution reduced her stock basis to zero.
That's because, the rationale, because, right, I can't reduce my basis in US dollars, I can't add the gain.
Suppose CCS began 2022 as a C corporation and elected to be taxed as S corporation in its second year of operation. In 2022, it distributed all of its earnings and profits as a dividend, so it did not have any earnings and profits at the end of 2022. In 2023, it distributed $30,000 to Nicole when her basis in her stock was $35,000. What are the amount and character of the income she recognized on the distribution and her basis in the stock? Nicole has no income on the distribution and $5,000 basis in the stock after the distribution, the same $35,000 minus $30,000. Because CCS did not have C corporation earnings and profits at the time of the distribution, her outcome is the same as if CCS had been taxed as an S corporation since inception.
Yeah, so that goes back to your first part of the example. And so, the presence of accumulated E&P makes things complicated, but you don't necessarily have to have that. You could have flushed that all out with the dividend, then filed the S election, and then be clean. It'd be as if you started from inception. Okay, so let's do non-cash property. So cash property is very simple, just like PERC. So if I'm dealing with non-cash property that's being distributed out, the S corporation implications, I recognize gain but not loss as if the S corporation sold the property at fair market value and gain is reported by the shareholders. So the rules for distribution of non-cash property from S corporations differ materially from those applicable to partnerships. Okay, so now we're getting further away from the partnership world, much more like the corporate, the C corporation rules, which is when we distribute property in the C corporation context, you go back and review that. It's the same recognized gain but not loss. You do that as if you sold the property. Now, in that instance, the C corporation, as being a separate taxpayer, has gain or loss on that transaction. Right? Distributed property. Here, the S corporation is not a taxpayer, but it can generate gain that then goes out to the shareholders. It would increase in those examples we're going through the one-third distribution on that. So the shareholder implications, the amount of the distribution is equal to the fair market value of the distributed property. Why is that? Because it's a taxable event to get the property out of the corporation. So the shareholder takes a fair market value basis in the property and equal to its fair market value. The shareholder's share of the gain created, which I just mentioned, on the distribution of appreciated property results in a corresponding increase to the shareholder's tax basis in the S corporation stock because it's taxable and it flows through that. So that first line in the dynamic slide or the slide that was showed the dynamic outside basis in the partnership, I would have more in that first line. Additional recognition of shareholder level gain is possible if the fair market value of the distributed non-cash property exceeds the shareholder's tax basis in the S corporation stock. That's different than the partnership world, right? Because in the partnership world, remember that rule was I could just adjust down the basis in the distributed property. We had like one or two examples where I just took the gain I would otherwise have recognized and I embedded it in the distributed property, so I preserved the non-taxability, waiting for me to do something with the distributed property and trigger the gain. Here, the amount of the distribution is the fair market value. So if the fair market value exceeds my basis in the stock, then I can't go below zero in the S corporation world. So I deviate from the partnership rules here as well. So just keep this in mind. This is a much different, even though cash is the same, non-cash is vastly different. Partnership rules. Do that 11:41. Our last example.
Assume that at the end of 2024, CCS distributes long-term capital gain property, fair market value of 24K, basis of 15K to each shareholder. So aggregate property distribution of 72K with an aggregate basis of 45K. At the time of the distribution, CCS has no corporate E&P, and Nicole has a basis of 10K in her CCS stock. How much gain, if any, does CCS recognize on the distribution, and how much income does Nicole recognize as a result of the distribution? So CCS is going to recognize 27K of long-term capital gain, and then Nicole is going to recognize 14K of long-term capital gain. CCS's gain is just calculated as the fair market value of the distributed property, which is 72K, and then we subtract out the basis in that property of 45K. And then for Nicole,
Sorry, just so that would be the same calculation whether it's a C Corp making this distribution or the C or the S Corporation that sold the property. All three of those instances, this one and those two, would be $27,000. One would be taxed at the C Corporation level, another one gets sent up one-third in the S Corporation.
and then for Nicole's long-term capital gain, it's the sum of her proportional share of CCS's long-term capital gain plus the amount that the distribution exceeds her basis in CCS. So for that first portion, her share of CCS's gain is just going to be a third of the 27K, which is 9K. And then steps 5 through 8 here show how to calculate the additional gain she has to recognize because the distribution is in excess of her basis. So first we actually have to increase her basis in CCS to account for her proportional share in their 27K gain. So that increases her tax basis in CCS to 19K. And then since she received 24K, which is obviously greater than 19K, that brings her basis in CCS down to 0, and the excess 5K is the second component of her long-term capital gain. So ultimately, she's going to recognize 14K long-term capital gain, which is the 9K plus 5K.
Yep, perfect. And so this would be vastly different than a partnership, right? In the partnership, she would not have recognized the 5,000. We would have adjusted down the 5,000 for that would have been embedded in the gain on the non-stock property. Oh, this was a cash distribution, right? Oh, sorry, crap, what I just said. This was a cash distribution, exactly the same. I got a distribution of cash in excess of my basis. Whether this was a partnership or an S corporation, I would recognize the 5,000. Okay. So I put up here at the top. I think they start the calculation at the corporate level, but I always think in terms of picture in my mind. So I think of owners on top of what we own, so shareholders above the corporation. So I start at the bottom. What happens at the corporate level? What happens at the entity level? Start building up from that, and whether you have an outside basis adjustment or not, and then was there a distribution following that? I just think that's a good way to think about it. Start from the lowest level up, which they do here. So filing requirements. S corporations are required to file Form 1120-S, which is U.S. income tax return for an S corporation, with the IRS by the 15th day of the third month. That's March 15th, after the S corporation's tax year ends. Why is it March 15th? Most S corporations have to be consistent with their owners' tax years, and those are lots of individuals, principally, are owners of S corporations. So I need to match the calendar. So I do March 15th. Why? Because they're going to send me out my share of the income plus my share of separately stated items. And then if I'm an individual, I have a tax return due on the 15th day of the fourth month, April 15th. So I got 1 month between when they send me something, then I have to get that onto my tax return. Now, they can't extend the 6-month extension if they're not done with the tax return. That would require all the individuals that are S corporation shareholders to extend as well. Because they can't file the tax return if they don't have their S corporation K1. They don't know what to include. And it's the same March 15th date as C corporations, with the automatic SIP extension, which nearly every C corporation. Okay, this is a really nice chart. I'm going to work you through this. This is an exhibit from the textbook. But what it does is it kind of goes through the different topics we covered down the left-hand side and compares that across C corporation, S corporation, and partnership columns. And I just want to kind of walk through this because I want you to be, one of the things to take away from this course is how different things happen in different business entity types. So let's talk about formation, contributing property. C corporation, no gain or loss, you have to meet the 351 requirements, right? 3 requirements. Transfer property, exchange for stock, control group. S corporation, same as C. 351 is the governing document. Partnership, no control requirement, right? I just have to get a partnership interest back. I can do 0.001 ownership and I can still make that non-taxable. Owner restrictions, there are no restrictions on who can be a C corporation owner, right? I've said many times, you guys can buy stock in whatever publicly traded corporation you want right now. Nobody cares about your tax profile, what you are, if you're an LLC or partnership or whatever, it doesn't matter. S corporation, obviously we do. And those are only individuals who are U.S. citizens or residents, certain trusts and tax organizations that we didn't cover. But the reason being there is because we were taking what would otherwise be taxable, because an S corporation is a U.S. corporation, and making it flow through. So we want to capture all of that income in U.S. taxpayers. We're just moving it up a level, but staying within the U.S. tax net. Partnership, no restrictions, right? You can be extremely flexible on your owner restrictions.
Yeah, if you pass the substantial presence test, do you qualify?
Yes. Yeah. So if you go way back on some of our discussions, if you are a U.S. taxpayer, a U.S. and maybe that's because you're not. If you're a U.S. citizen, you're a U.S. taxpayer. But if you have a presence in the United States in certain thresholds, you become a U.S. taxpayer by virtue of your presence in the United States. That would make you eligible to be an S corporation. Okay, number of owners allowed, C corporation unlimited. Right? The only limit you have is by number of shares, and even then, I think most brokerage platforms you can buy fractional shares as well, so it's probably truly unlimited. Maybe a practical side, and most people want to own that whole share. But you can have as many shareholders as you want. S corporation, we know we have that cap. We can't get above 100. It prevents us having S corporations be publicly traded because you can't manage that publicly traded asset. S corporations is unlimited, so you can have the maximum number in your mind you can get of partners is fine, but it is somewhat limited compared to a corporation because you have to have at least 2. A corporation can have 1. There's plenty of corporations that have single owner. Plenty of S corporations with a single owner. You cannot have a partnership with a single owner. By definition, you have to have a partner. Okay, an election. C corporations, there is no election. Right? You default if you are formed as a corporation under state law. You become a corporation. As a corporation, we know we must formally elect. Right? It's an affirmative action by the taxpayer. Nothing happens to you that you don't want to have happen. Okay? Partnership, your default status, if you are unincorporated, so you are not formed under state corporate law, and you have more than 1 owner. That's the 2 requirements that it's going to make you be a partnership. That's why LLCs owned by multiple owners becomes a partnership for tax purposes. Not incorporated. LLCs are not formed under corporate law. They're a liability company. If you have more than 1 owner, they become partnerships for tax purposes. That's your default classification. Remember, we can change that if we want under the entity classification election. But again, that's something that has to affirmatively be done by the taxpayer. Okay. Income and loss allocations, we know that doesn't happen in the C corporation context, right? Separate taxpayer. No such thing as allocation of anything to anybody. You're the taxpayer. We just went through, we know we're allocated our share of those items from an S corporation based on our ownership percentages, and then it gets more complicated in the partnership because they flow through and they can be allocated based on something other than ownership percentages or special allocations. So I get real creative in the partnership context. 100% has to go out, but how I divvy it up amongst partners is the subject of the partnership agreement. Entity level debt included in owner's tax basis? No. Corporation, right? No point in time do we talk about we adjust our tax basis for corporate level debt in C corporation context. S corporation, the answer is generally no. There's some special reasons why it might be, but as a general matter, you're not going to run into that, so no. And we do know in partnerships we do. And that's because partners might be called upon to satisfy partnership level debt in the instance of default. Okay? And so we have to go through recourse or non-recourse debt. Okay, loss limitations. So if the business entity is generating losses in their business, we know C corporations, it's just stuck in the C corporation, right? It doesn't go away, it's now carrying forward for future years, but inside the C corporation, waiting for income in the C corporation in the carry forward year. Okay? S corporations, they flow through, and partnerships flow through, same as S corporations. The verbiage here, we covered this in taxation of individuals. And the reason being is because it's going to flow through to the individual, right? The loss is going to be reported out by the S corporation, reported out by the partnership. We have hurdles that you have to use, overcome to utilize that loss. Remember the tax basis limitation, the at-risk limitation, and the passive activity loss limitation. And then there's an excess business loss limitation. Why? Because losses are different. We covered that in individuals because they're only deductible for individuals. Those limitations are only applicable for individuals. And it's because you're going to try to take that ordinary loss that comes up and offset your other ordinary income, salary income, interest income. So the government's interested in that offset, and that's why they put those. Okay. Self-employment income, we didn't talk a ton about that in individual, but obviously not applicable in a C corporation, separate taxpayer. S corporations do not generate self-employment income. So when we did talk about self-employment income, remember that's the Social Security and Medicare aspect, but there's no employer-employee relationship because you're self-employed. S corporation, you're not considered self-employed, so they do not generate self-employment income. Partnership, you may be considered self-employed depending on your level of activeness within the business of the partnership. If you're a day-to-day employee, you're a passive real estate investor, maybe you're not. Is salary permitted to owners? Obviously in an S corporation and a C corporation, S corporation, yes, you can have owners who are also employees. That's transfer pricing. You got to pay them for the value of their services, and they can't pay them more or less depending on the tax results. You have to pay them for the services provided. Partnerships, you don't technically pay a salary; you get a guaranteed payment for services, but it functions much the way a salary does. It's income to the partner, and it reduces the partnership income by virtue of the guarantee. You got guaranteed. Skip fringe benefits, operating distributions. These are distributions to the owner. What are the owner implications? They're taxable to the extent of taxable as dividends to the extent of earnings and profits. That seems to be high on the list of the review comments we'll talk about in a moment. But remember, if I have earnings at the entity level and I distribute those out, that's the double taxation of that. So that's taxable as a dividend. After tax profits give rise to the dividends, so it's 2 layers of tax. No, generally not taxable to the extent of the owner's basis. An S corporation, the same for partnerships, right? That's the maintaining of that outside basis. The entity level consequences, gain on distribution of appreciated property, not loss. S corporation is the same. And generally no for the partnership, right? Because I can embed that gain in the distributed property as long as it's not cash. Last one. So liquidating distributions, corporations that generally recognize gain or loss on distributions. You go back there, there's an exception for corporations owning other corporations, and it depends on the amount of stock ownership between the two. May make it non-taxable. That same rule applies for S corporations. We did not talk about liquidating distributions in partnerships. If we did, we would talk about those for probably at least a week and a half. Extremely complicated stuff. Okay, entity level taxes. Yes, we know corporations are taxed 21%. S corporations, no. The verbiage that's in that box there is for S corporations that were previously C corporations. There could be some special rules that are there, and partnerships just do not pay entity level tax. Okay, so that's a very nice, just tumbling through there, make sure you're kind of like thinking through the different comparisons based on type of topic. So that was a sample of S corporation stuff. There's a lot more to that. We just do not have time to get into that. So what I prefer to do is spend some time on some of the review topics, and I'll just take them from the top. Okay, let's do ordering of corporate distributions, and that is chapter 7, if you want to pull that up. Do that. Should be around slide.
Coffee is caffeine. Iced coffee.
Okay. What I purport to do here is I'll just walk you through what I think are the key things to take away from that. So. Okay, so remember we got 4 possible permutations with the C corporation. So I'm looking at current E&P and I'm looking at accumulated E&P, and at any point in time one of those might be negative. Like if you 4 scenarios. So I either have positive current, positive accumulated, which is matched by number 4, which is negative in both. And number 2, I could be positive current, negative accumulated. And number 3, opposite of 2, negative current, positive accumulated. So each one of these has key takeaways as to how you deal with those. Okay, so and Exhibit 7.3 might be worth you tumbling through and making sure you understand that, but they summarize the rules that are articulated on these slides. So if I'm positive between the two, the only thing that is the nuance on the distribution is first it's coming out of current E&P, which is allocated pro rata to all shareholders based on their ownership percentage. Which means if I have multiple distributions in the year, each one of those distributions gets a share of current E&P. It's not a first come, first served. Okay? But I have to do that first to current and exhaust current. And then I go anything in excess of that was distributed, I dip into accumulated E&P, and that is first come, first served. Multiple distributions in the year, the earliest distributions will start fully taking out accumulated E&P, which means later distributions in the year might get stuck with no accumulated E&P allocated to it. Why is this important? Remember should have started with the first rule. First, distributions come out to the extent of E&P, then to basis, then to capital gain. Right? So who is getting these things? You want to kind of like fill up the first 2, because if you fall to the third criteria, you're going to end up with capital gain. Okay. If I am positive current, negative accumulated. Think of what fact pattern that might be. That's the one I mentioned that a startup has been losing money for its startup years, then it turned the corner and made money in the first year. The rules are incentivized to say you can pay a dividend, the nimble dividend concept. You can pay a dividend to the extent you have current E&P. You don't have to be in total positive. Okay? So what does that mean? You have a distribution of current E&P. If you have more than one distribution in the year, then that same rule we just talked about, each distribution in the current year gets its pro rata share of current E&P. But then you don't have accumulated E&P, right, because it's negative. You can't distribute out of negative balance. So in your normal 3 ordering rules, your first one is a distribution of current E&P. You don't have accumulated E&P, then you go straight to basis. You get a reduction in basis, and you decide if you got anything more or was distributed in those basis. So the second category is just nimble dividends, startup stuff. Losses that I made money, the rules want you to be able to pay dividends if I have current. And then negative current, positive accumulated. So my fact pattern of this is pandemic. I was always profitable, and then the world went crazy, and I lost money, right? Well, now I can still pay a dividend because I have accumulated E&P, but the trick here is I have to prorate the current loss to the date of the distributions. So I put the current E&P, I have to get to the real E&P balance when I make the distribution. So I got to prorate the current year loss up against the accumulated E&P to tell me how much is really left at the date of the distribution. So that's in my 3 distribution criteria. That's going to lower my amount that can be distributed as E&P, which means I get to number 2 faster, which is basis. I get to number 3 faster. Okay. So if I'm negative current, positive accumulated, then I just got to prorate. That's the proration. Number 4 is not even anything worth thinking about. It's negative current, negative accumulated. So you just have been very good at losing money. And so you can't make a dividend. Right? You don't have any earnings. Dividends or distribution of earnings. So you 3 criteria, you knock out the first one, you can't pay a dividend out of negative balances. You go straight to basis. Anything excess of that is cat game. So I think these, if you just have those little tricks in your mind, I think you can work through these 4. You just read the facts, which one am I in? Step back from it and then understand what the rule is. Okay. Book tax differences. Okay. This is chapter 5. Okay, book tax differences. I talked to several of you about this offline. I like to think about the columns. Okay, my first column is my book income, my financial statements. My second column is my adjustments. On my way to the third column, which is my taxable income, my tax return. Okay, so the reason I identify book tax differences is because I got a great starting point. I got financial statements. Right? Publicly traded, I got audited financial statements. So I start with that. Remember, I don't have that in an individual site. I have one. I know most people don't, but you have your that's why you have to start looking at everything kind of holistic. Here I got a shortcut. I can just jump straight to books and then start saying, what do I want to change about books in order to arrive at taxable income? And that's where Congress comes in and says, oh, these things are not taxable, these things are not deductible, these things are limited. So they start having all those rules. That's the adjustments we're making. Right? Because we could have had a rule where we just take book income times the tax rate. We don't have that. We want to deviate from book. So I like to think about whether something is permanent or temporary or favorable or unfavorable as to how it flows through those first column to third column. Okay? First of all, it's permanent or temporary, right? Will it ever equal over time with book? Okay? Will I get to the same number? It's just the methodology of how I get there is different. The classic is depreciation, right? Counting depreciation is straight line over useful life. We know for tax, it's very prescriptive. We have tables and we have accelerated depreciation and special rules, and we'll no doubt have more special rules in the future, right? Always monkeying around with depreciation. So I'm going to have a book tax difference, but those are temporary items because I'm ultimately going to depreciate the cost basis of the asset. And nearly every time, my cost basis for accounting purposes is the same as it is tax purposes, right? It's your purchase price. Buy a piece of machinery, it's the price. But accounting has a different life that they take it over. Tax has a different life, but we end up at the same place. We end up at zero. We hold it first. We'll use that. Permanent items will never equal. So it's a very stark either non-taxability or non-deductibility on the tax side. Either that income is not taxable and it will never be taxable, or it's not deductible and it will never be deductible, right? So I'm going to never equal over time. So that's the only difference between permanent and temporary. When I do my temporary items, that's where, well, I think the next item is deferred tax assets and deferred tax liabilities. Only temporary items give deferred tax items. Deferred items are things that are going to happen in the future. If it's permanent, there's nothing going to happen in the future. It's over. Right? If it's a fine, let's say the company gets a penalty from the SEC. They have to pay the fine, but the government says that's non-deductible. I'm not going to partner with you in violating SEC rules, right? That's non-deductible. There's nothing deferred about that. Nothing's going to happen in year 2 or year 5, right? So it's not a deferred item, only temporary items. That's why we have to make that classification between permanent and deferred. If you're really thinking through this, this is why from a planning standpoint, if you're advising a company and they're interested in driving down their effective tax rate, the only thing that drives down effective tax rates are permanent items. Because a deferred item, when you go through that 5-step tax provision calculation we spent time on, you will book tax expense or tax benefit for your deferred items. Meaning that it will affect your tax expense, which will either increase or decrease your effective tax rate. So it will impact your cash payments, right? Accelerating a deduction gives you cash savings. Deferring a payment gives you a tax savings because you're not making a payment. So those companies might be interested in the cash aspects, but it's not going to affect your effective tax rate. Okay? And the favorable or unfavorable, I think this is one where people have most trouble. It's favorable, unfavorable. Think of it as you are the taxpayer. Okay? My only favorable tax paying items that I can ever be interested in reduce my tax because I get to keep more money. Okay? So think about that. If whatever adjustment you're making, is it raising or lowering your tax payment? If it's lowering, it's favorable. If it's raising it, it's unfavorable. I don't like unfavorables, right? I can write a bigger check. I have less money in my bank. So that adjustment is you're moving from column 1 to column 3. What are you doing to book income? Net income. Are you raising it? That's unfavorable because you're going to be taxable. Are you lowering it and getting to column 3? That's good. That's favorable. Right? To me, that just helps me think through whether it's favorable or unfavorable. Right? Flowing from book income to get to taxable. think that's what I was just talking about. I think the best way I would approach this is work through these examples. Right? Just plastic, yes.
Is this a temporary difference that must reverse in the future?
Yes, absolutely. You classify something as temporary, ultimately over time, and that time could be way out there, like a net operating loss is governed to be temporary. Now, in practice, it could be permanent, right? Like if you lose money forever, you're never going to get that attribute. But the accounting literature thinks like, well, ultimately, if you're in business, you're going to make money, so you'll be able to utilize it at some point in time. So, yes, a temporary item will you'll ultimately get you the same number. I think the stock options is probably the hardest one, and I would put acquired goodwill on that as well. Midterm, there was a question about acquired goodwill and whether it was permanent or temporary, favorable, unfavorable item. A couple of questions about that. Just, again, be very compartmentalized. What is happening for tax? What is happening for book? And think about them in those columns. What is my book column looking like? And I got to get to my tax. Am I increasing or decreasing amortization of the goodwill? Increasing it to get the book to tax is a good thing. That's going to be more deductions on the tax return, paying less. That's favorable. If I have a big impairment that I can't deduct, then that's a bad guy. That's unfavorable. So I'm not going to have it. Stock options. The stock options are on the non-qualified options, right? So non-qualified options give a tax deduction for the difference of the bargain purchase element, which is the difference between the strike price and the exercise price and the value. So how much are you buying that employer stock on sale for? Right? The employer has to deliver the exercise price that you're buying it, but you get to buy something on sale. That bargain element is taxable to the shareholder because it's value given, or taxable to the employee given to the shareholder, deductible by the employer. Okay. The reason you get book tax differences, stock options are treated differently for book. So on the grant date, they start amortizing the cost of the stock option over the vesting period. You go back and look at the stock option stuff. We don't have a tax event until exercise. Nothing happens until exercise because it may never exercise. So if you have a weird fact pattern where a stock option expires unexercised because it's been underwater, it's not worth what the exercise price is, you wouldn't buy something you wouldn't pay more than what it's valued. And accounting may have already taken a deduction for it, right? Because they're doing it earlier and over vesting period, but it was never exercised. So you got a permanent book tax difference once the stock option expires. So again, I think it's just healthy to kind of think through going from the book column to the tax column. Oh, the acquired goodwill. So remember the acquired goodwill. That's only in asset acquisitions. If you have a stock acquisition, your basis, your tax basis is in the stock. Stock is not depreciable or amortizable. Right? You have to buy assets. If you buy assets, then you spread the purchase price amongst the identifiable assets. Anything in excess of that can fall to goodwill. If you bought assets, that's acquired goodwill, amortizable over 15 years straight line for tax. I think there was a question on the midterm where I started asking you, what do you do with this goodwill? Well, it was in a stock acquisition. You do nothing with it from a tax perspective. Now, accounting treats, accounting expert, but I think accounting treats it very similar whether it's stock or assets, right? They push the purchase price down into the assets and put them on the acquiring company's balance sheet. Anything in excess, they'll put the goodwill. Goodwill is not amortizable for accounting, right? It's tested for impairment on the balance sheet date. Is it worth what you paid for? Right. Let's do DTLs and DTAs. Okay, that's chapter 6, slide I'm just gonna pick up with, step 2, because step 1 was just identifying all your permanent and temporary differences. That's that second column in that exercise. You went through all that, got that all done, and calculating your current tax provision, right? I take column 3, whatever that estimate is at the bottom, taxable income, tax 21% in the corporation. That's my current tax provision. Step 1 in this calculation is always the best estimate of what you think your current year tax return is going to look like. That's your U.S. federal return, it's your state return, it's all your foreign jurisdiction current year tax returns. Right? So now we're going to start dealing DTAs and DTLs. These are our deferred items. So these are things in the future, which, as I mentioned earlier, is the only reason we deal with temporary items, right? So here, the language is a little different. Taxable temporary differences and deductible temporary differences. So we know they're temporary differences, or we wouldn't be talking about because these are only the deferred items. The taxable and the deductible references, I just take into account as favorable or unfavorable. The accounting literature doesn't use the language favorable or unfavorable, but a taxable temporary difference means I'm going to pay tax in the future. That's unfavorable. It's deductible, that's favorable. I mean, a future lower tax liability, right? That's just when you be careful when you're doing TTDs and DTs.
The thing about the unfavorable and favorable though, that's like in the future, not.
Yes,
Is that
in the
the moment?
future, in the future, yeah, you're right. Yeah, it's the same thing. Greg, I'm glad you brought that up, Mars. So in step 1, it's favorable, unfavorable onto the current tax return. In step 2 is it favorable or unfavorable in the future. All about whether I got to write a check, bigger check, or I get to keep more. Right? Think of it as you paying the tax. Okay. We got taxable temporary differences. I would just work through this area. I think step 2 is the hardest step, right? Because step 3, if I go back, step 3 is the deferred tax provision. That's just tax affecting those deferred items, deductible or not. And then step 4 is just a valuation allowance. I have to pressure test my deferred tax assets. Are they real? Am I actually going to use those? That's just the accounting skepticism with any asset. You can't carry an asset greater than its value. Do that here with a deferred tax asset. I don't do it on DTLs, right? We don't question whether a liability, are we sure we're going to pay it or not? If we think we're going to pay it, it gets accrued, right? Conservatism. And then step 5 is uncertain tax benefit reserve. So I think all the complexity here is in step 2. We blast through step 2 and talk about taxable temporary differences. So there's property, plant, and equipment, and note receivable. So these are items that are going to give rise to tax in the future. So think about where you are. In property, plant, and equipment, accelerated depreciation means you have a lower tax basis than you have book basis. Here you're always deemed to sell the asset for its book basis. Right? That's the whole fiction. That's what I tried to depict in these examples. The spreadsheet is a fictional sale, a deemed sale of the asset. So if I had accelerated depreciation that took my tax basis lower than my book basis, I take it earlier and faster, then I'm deemed to sell it for my book basis of 100. My tax basis is what it is, always what it is. It's 70, so I'd have a $30,000 gain in that scenario. It's just a fiction. Just don't think about what it's worth. It's irrelevant. The accounting literature is just deemed to sell it for book. Book is 100. You get that number from your accounting colleagues. You're like, I know what the tax basis is. I'll look at that. And then I deem to sell it for that and do my normal gain calculation. I have a $30,000. Think about what that is. Oh, that would be a gain. I got more than what I had a basis. That's a $30,000 taxable temporary difference. Okay? That would give rise to a DTL. Right? that I'm gonna pay that tax in the future. And why? Because it's gonna flip in the future, right? Because accounting's gonna keep going this, and my depreciation's front-loaded for tax, so it's gonna gradually go down, or rapidly go down. And then I'm gonna have more book depreciation than tax depreciation in the future. Which means my middle column, I'm gonna have to reduce the book depreciation to arrive at my tax depreciation, which is unfavorable item. So I think if you just think through these things, but step 2 is all balance sheet focused. Settle the liability for the book value of the liability, sell the asset for the book basis of the asset. Compared to what is taxed, that's going to tell you whether it's future taxable, future deductible, PT, TTB, or DT. Okay. And I did this on the liability side. I think the liabilities are harder to deal with because it's not as intuitive to me. I can always think of sell an asset, cover the basis. What is that? Gain or loss. Liabilities are a little different. Liabilities are a little bit more. One other thing on the. And it's always the ending balances, right? So I have a DTA. When I get to December 31, I'm deemed to sell the asset, if I'm dealing with an asset, at its book basis, recover my tax basis, gain or loss. Then that's what I want on my DTL, if I had a DTL, if it was a gain item. Then I just take that number and I compare what's already on the balance sheet for that DTL. That's my difference. That's my change in my deferred tax liability. That's what would drive my deferred tax provision. Real quick, I want to show you a wrap-up slide. This is, I think it's good to zoom out. We covered a lot in this course. But it's a flagship course on tax. I help you on all things when you're dealing with these large institutions. But think about where we are. So from a corporation standpoint, we had formation issues, we had operating issues, which is all the distributions and the computation of your taxable income. That's step 1 in the provision process. Tax accounting, which we just went through. Distributions from the corporation, and M&A, right? Buying and selling of assets on the corporate side. On the partnership side, we had similar topics. That was that whole chart we just went through at the end of the last chapter, right? They were comparing over similar topics, the different treatments and the things. So we had formation of the partnership, we had taxation of its operations, and we had the operating distributions, and we had sales of partnership interests. We just covered S corporations similarly. Formation, taxation of operations, operating distribution. I think if you just focus on what you already understand, and you kind of grasp, then hone in on what you don't quite get yet. Spend your time on that. Okay? And in the middle, we had a whole bunch of things that are spread, that it's agnostic to whatever business entity you're at. Your business income deductions and accounting methods are across the entities, right? We started off with those because they were agnostic to corporations, partnerships, U.S. corporations. Property acquisition, right? Your basis determination, your cost recovery. It doesn't matter if you're an S corporation or a partnership or a C corporation. Those tables are exactly the same. And then property disposition. Those rules are always the same no matter what type of entity you're in. So I think it's just good to kind of step away from the gory details in some points and just make sure you kind of understand how all the parts fit together, and then just examine, are you weak in one area? Is it the tax accounting stuff? I can promise you, if you spend more time on it, it will get better. It will get better. And you know, talk to your colleagues or look at the examples, do some AI searches, whatever is going to help you try to understand that topic, because a different voice might be a little better for you to understand. Okay? So I know it's been a lot. I hope you guys feel like you learned a lot more about corporate taxation, partnerships, and all the criteria that we go through and all the different topics that might be important. If you have any questions before now and Monday, certainly send me a note. Okay. All right. Thank you.
And then the Friday one is my Texas class. Usually I have to be like, but then I was just like, you know what? He can't do this to me anymore. I will win. If I don't want friends, how was the rest of your pretty much everything's done besides just hang out. Like, do a hobby. I'm not ready for that. All I can say is like, my name is Aitza. That's it. What was one? Yeah, I like to. That's all I've learned this semester. 你不要往那边走。
Are you a fraud? Yes. Okay. I just have to get the card from. That's the process.
Are you in a Yes? Yes?
Invisible.
I'm invisible. Yeah. You know Harry Potter. Have you always had your hair blue? Because I didn't realize your LinkedIn helped. Or maybe you're.
Oh, right. Oh, that one was taken
Like at your graduation.
by senior.
Your senior. So how long have you had it blue?
So for that part, I just dyed black.
Okay.
And when I come here and I realized I can't just rebleach again.
Yeah.
Because I'm very Chinese. I think you're Chinese.
You did her hair, right?
Yes, she already
Yeah,
did.
she's good.
So you're next, right?
Oh,
Yeah,
and you know, also just asked me, could we get more pizza today? And I was like, okay, let's do the other beer cost. Also, because like, no, we don't want it. Arthur.
Let's say. Oh my god, do not.
Hopefully he doesn't kick me out.
Huh?
Hopefully he doesn't kick me out.
No.